Most investors see a market correction as a disaster. But for covered call ETFs, increased volatility can increase income. And that's exactly why funds like SPYI, QQQI, GPIX, and GPIQ become so interesting during uncertain times. These ETFs are built around one core strategy: selling options to generate income. So when volatility increases, as does that options premium. That means these funds can produce more income while the market is panicking. One main concern I hear from investors of covered call ETFs is how will they perform in an ongoing bear market? Today, I want to look at each of these funds and how they performed during the April 2nd, 2025 Liberation Day, which sent the broader market and the Nasdaq tumbling 23.8%. Did the distributions decrease as some would expect? Did they increase with increased volatility? And how did these funds perform against the broader market during this time of uncertainty? As well as how did these funds recover? If you had held these funds through Liberation Day since inception, would you have been able to take your distributions without needing to reinvest? Stick around because the results may surprise you. So as always, guys, this is not financial advice. Let's get started. So for anyone who doesn't have personal experience selling a covered call, just a little backdrop as to how these funds work. So when you're writing a covered call, you're just offering to sell the stock that you already own at a predetermined price, usually higher than what the value is today. Older covered call funds like XYLD would sell an at-the-money covered call, which means if you give me a sum of money, I will sell you my shares for the market price today. Now, if the price goes down, that person that you sold the covered call to would not want to buy it because they would be paying a premium. If the value went from $100 down to $95, they wouldn't want to pay you the $100. So the person buying the covered call may anticipate that the stock is going to go from $100 to $120. And in buying that $110 call option, they would be able to exercise that and make $10 a share. Covered calls are usually sold on around 100 shares of an underlying. I'd like to look at the price return of these four funds. If you had simply held since inception, starting off with SPYI, total price return is 8%, while the S&P has returned 84.4%. This assumes you took your distributions and spent every last penny without any reinvestments. To get a better picture, we look at the total return. Since inception, the total return has been 70.29% compared to the S&P's 94.5%. As we see, SPYI has not kept up with the index, though has had some capital appreciation and distributed mainly tax-advantaged return of capital distributions. But how consistent were these payouts, and did you take a big hit to your income during the Liberation Day sell-off? Looking at the dividend history, April 2025 was on the lower end with a 6% decrease from month to month. We do see this rebound quite a bit as the market recovered, quickly returning to 50 cents plus per share. Next, let's look at SPYI's sister fund, QQQI. If bought during inception, you would be up 12% on price return. And on a total return basis, you'd be up around 56.9%, around 10% less than the Qs returned over this same time period. Looking at the Liberation Day distributions again, a little bit of a decline to 53 cents, though a very nice rebound again. When looking at the max pain sell-off of QQQI, it was able to slightly outperform with a drawdown of only 19.88% compared to the Q's 22.75%. So the NEOS funds did survive and pay distributions with only a slight decrease during the Liberation Day sell-off. Now, how did the Goldman Sachs funds do? Better or worse? Looking at the GPIX price return since inception, 40.51 compared to 75% for the S&P 500. On the total return front, 73.84% compared to 81.1% for the S&P 500 index. We do again see some lagging of the index as we sell away our upside with covered calls, though we're tracking fairly closely overall and still returning predominantly return of capital. But how did the distributions do? Actually, a very negligible change consistent with the fund's usual ebbs and flows, only slightly down in April and May as the uncertainty in the market peaked. Here it's harder to draw a comparison as Liberation Day was on April 2nd and the distribution was on April 1st. Though again here, less than an 8% total change from 35 cents in February to a max pain of 32 cents in May. Now looking at the GPIC price return since inception of 49.46%. Total return of 94.46%, very close to the Q's 101.53% over the same time horizon. Looking at the distribution during Liberation Day, we have an April distribution of 38 cents and a May distribution of 38.8 cents, with it back to 40 plus cents in June. From the February peak, again, we see about another 8% drop with a rapid rebound. Now comparing max drawdown at peak on April 8th, QQQI decreased the least at 19.88%, with GPIX in the middle at 20.95%, and then the Qs with the worst at 22.75%. With these funds only being a few years old, looking at the trailing 12-month dividend growth rate, SPYI is the lowest at 1.9%, QQQI is next with 3.74%, followed by GPIX at 7.2%, and GPIQ the highest at 9.33%. One worry I do have about the NEOS funds is, will they be able to outpace inflation? With less price return and less dividend growth, I do feel taking the higher distributions of SPYI and QQQI might be prudent to reinvest some of those just to get a little more share appreciation so you are growing your distribution over time. Because let's face it, $50,000 in today's dollars will not have the same purchasing power as $50,000 20 years from now. I feel the key takeaways, regardless of which funds you are in, both the NEOS and Goldman Sachs funds performed well during and after a black swan event and maintained distributions with only a slight decrease as the market recovery and increased volatility allowed both issuers to rapidly return to the previous payout. Both distribution declines were less than 10%, which is a small enough amount that if you had been carefully planning, you should already have this accounted for in your retirement plan. Since inception, all of the funds have lagged the market, as expected when you sell your upside with covered calls. Given the market's recovery, both the NEOS and Goldman Sachs funds were able to participate in a significant portion of the upside coming out of the Liberation Day sell-off. I'd like to briefly look at XYLD, an older covered call fund. The main difference between the newer funds examined in this video and this fund is that this fund sells covered calls on 100% of the notional value at the money, while the newer funds adjust and may sell on only a portion of the portfolio, and they usually sell out of the money covered calls so they can participate in more of the upside. Even with a lesser strategy, we can see that during the COVID pandemic, it was able to recover and has a 45% total return over the past 5 years. The question investors need to ask themselves is simple. Do you want maximum upside in bull markets? Or do you want a portfolio that prioritizes cash flow and a smoother psychological holding during volatility? Knowing that regardless of what the market's doing, income will be coming in. Because for many people, the hardest part of investing is not the math. It's staying invested when the markets get ugly. If you miss just the 10 best trading days over a 20-year period, your returns are typically cut by more than 50% compared to a simple buy and hold strategy. So maybe the real advantage of covered call ETFs isn't the yield. Maybe it's the ability to generate income during the exact moments most investors are most uncomfortable. Because when the markets get volatile, fear increases, but so do options premiums. And funds like SPYI, QQQI, GPIQ, and GPIX are built specifically to turn that volatility into income. It doesn't make them perfect by any means, and it definitely doesn't make them risk-free. But in a world where many investors are searching for a balance between growth, income, and psychological peace of mind, these strategies are becoming hard to ignore. As always, guys, my friends call me Taylor, and you can too. As you may have seen in some of my previous videos, the average age that men in my family live to is not very old. It's actually 50. My uncles and brother and dad all kind of met their demise in their 40s and 50s. So I am just trying to use investing as a means to have a happier, healthier life and enjoy that with my kids because, you know, we don't know how many days we are blessed on this earth. So if that seems of interest to you, you know, follow along, hit that subscribe button.